We are going to learn how you can actually get the implied volatility over historical data for 10 years using the ThetaData API. Now here we're also going to explain what the difference is between actual or realized volatility or historical volatility to implied volatility, and how, if you believe that there's autocorrelation between these two processes, this can actually help you with your decision making in the future or your understanding of volatility in general. We're going to be actually exploring the implied volatility of at-the-money options over historical 10 years of data for Microsoft. So what is the difference between historical volatility and implied volatility? Well, let's start with historical volatility. Historical volatility is the actual variability in the stock price that materializes over time through randomness. Now, this randomness is formally described in mathematics as a Wiener process or Brownian motion, and we've actually created a video on what this is in finance before, so if you're interested, check it out. Now, essentially, there is a model that underlines this price movement, and here we assume that the underlying model is geometric Brownian motion, and essentially what that means is that when you take the stock returns model, you get something that looks like this with log returns. Now, when we then calculate the randomness in volatility over time, essentially you get that the realized volatility is just the coefficient of the Brownian motion term, or that Wiener process term here. So this happens under the physical probability measure. Now, if you don't know what I'm talking about here, that's okay. We can explain that in a further video. Now here, the realized volatility over time, we actually get the sum over an entire period of time. We get the square root of the sum of the squared log returns. Now, if you wanted to compute the realized volatility for each time period you're considering, for example, on a daily basis or a 5-minute basis, then you would use the unbiased standard deviation or the biased standard deviation to then compute your returns. Now, why do you use the biased standard deviation? Well, really, sometimes you can be dealing with a large volume of data, and many papers have shown that there is an insignificant difference in reality between these two methods. But I will leave that for your further investigation to judge. So essentially, this is the volatility that actually transpires on a day-to-day basis. Now, the implied volatility, on the other hand, is actually the implied volatility of how the market is pricing the option currently. So what does this mean? Well, to calculate implied volatility, you use the market price of an option as well as all the contract terms. Now, there's also a theoretical pricing model that's actually dependent on a type of option you're pricing. For example, if we're pricing European call options, then we might use the Black-Scholes model. Now, the Black-Scholes model looks like this, where you have the call price is equal to the strike times by the cumulative normal distribution function here, we've got it as phi, with the parameter D1 minus the strike, the expected discount rate with the time to expiry, multiplied by the normal cumulative distribution function with D2. Now, D1 and D2 are defined below. But essentially what this means is that the implied volatility that results is the observed market price of the option. So for a particular option with a strike K and a time to expiry tau, there will be an observable market price. So essentially you can take that market price, and that's the call price observed in the market for a strike and tau, and you're going to then find a value of the implied volatility according to the model that then gives you that same price. So all other parameters being equal, you have the strike, you have today's stock price, you have the interest rate, which hopefully people agree on, and then you can have the tau. So everything else being equal, if I just change the volatility, what volatility does that need to be to match the market price at a particular strike at a particular time to expiry? So this can be obtained by a number of methods. We won't get into them here. I've made a video on a root finding method, Newton. You can use bisection, secant, Brent method, and there are actually more rational ways if you're doing this on European options, because it's a very difficult, easy problem to solve, if that makes sense. So we're going to get into a more rational way to compute this for European options in future videos. Okay, so you might say that's all well and good, but then what is the actual difference between what the market's pricing it in and what the historical volatility? We're looking at the math there, but what's an intuitive definition? Well, since the market does not have perfect knowledge about the future, these two numbers can and will be different. So therein lies the risk management problem for market makers and institutions that have to show buy two-sided quotes, and the actual business or trading opportunity that's present for hedge funds or other institutions. So I have partnered with ThetaData on this channel, and the reason I've done that is because I believe in the power of this API. So I am enjoying using it and how much information there is with 10 years of historical data, not just on end of day information, but intraday information on both trades and quote level data that wasn't even traded in that day. We're talking about hundreds and hundreds of thousands of data points for each particular option on each particular trade date. It's really incredible the amount of data that this API offers. So ThetaData API, if you are interested in actually purchasing a subscription to this API and following along with the tutorials that we're doing here, then essentially using my code in the description, QuantPi, when you go through and purchase, you will get 15% off for 2 months. Additionally, you're going to get 50% off your first month on top of that. So please take a look if you're interested, and I'm really enjoying the product so far. So let's import our dependency. So we've got OS, time, pickle, random, numpy, pandas, matplotlib for plotting, date, time delta, date, time, date, and then from ThetaData, we're importing theta client, option requirement type, option right, date range, data type, and stock requirement type. So first thing we're going to do is we're going to use the API to get all expirations for the Microsoft options. So let's see what they have available. First, you need to define your username and password for the ThetaData API. I have this in my environmental variables, and we define a function called get expirations. Essentially, all I'm doing is I'm enabling a ThetaData client, I'm creating it, I'm connecting to the terminal, and then I'm making a request for a specific root ticker. Now my root ticker that I'm looking at is Microsoft, and I get all the expirations back. So essentially here I get 561 different expiries, all the way starting from 2012 June the 1st. So that's over 10 years of historical options data. So getting the strikes for each of these specific option expiries, now we need to build up this dictionary, and then we're going to pickle this data down for later use. So I want the strikes for every single one of those options. So what do I have to do? Let's create a function that says get strikes. I'm going to create a ThetaData client. I'm going to then create a dictionary called all strikes. I'm going to connect to the terminal, and I'm going to iterate through all my expiration dates for a given route. I'm going to make the request, and then I'm going to add it to my dictionary. So I'll return that data as a pandas series and a numeric series. So you can make that API request just calling that function with your root ticker and expirations, and then I've pickled that data down for use now. And you can see that I've, for all my different expirations at different points, I can then return my ticker value. So that's very handy because obviously they move with the underlying over time. Now, the Microsoft underlying is very important for actually getting the historical volatility. So let's actually get the underlying through a request to ThetaData. So we're going to be leveraging the ability to aggregate time periods throughout the day using the API, and this is defined by the variable interval size. So we're going to be comparing the historical volatility to the implied volatility for every trading day using the quotes level data that were made in the underlying in the options at the money in the afternoon at 1400. So I've said a lot of things there, but essentially because of the transparency and amount of data that ThetaData has, we can actually get the quote level data for every single day, every time point. but that's too much. So we want to aggregate the data over a given amount of time. So let's say 1 hour. So I want the interval size to be 1 hour, and I'm going to get what happened between 1300 and 1400 every day as an average of what the market maker was quoting on that particular day for both the underlying and for the option price. We're going to do this. So let's actually now request the historical data for the underlying. So let's create the ThetaData terminal again. We've got an underlying dictionary that we're going to build up, connect to the terminal, and then we're going to iterate through the trading dates. Now for each trading date, we're going to try and get the data. So here we have to make the requirement stock requirement type quote, and then we're going to list the date range, which is just going to be 1 day, and we're going to get the interval size, which is going to be 1 hourly period. So then I return the 1 hourly periods back, and then if you do the math, we got 10 o'clock, 11 o'clock, 12 o'clock, 13, and then 1400. And then because Python indexes lists from 0, that is number 4. So I'm getting all that data back for a particular day, and I'm only interested in the 1400 time period. So I get that underlying back and I add it to my dictionary. If for some reason I can't get a price for that particular day, because I'm not being very careful with whether there was a particular holiday back in 2012, I'm just doing business days with my trading days, I'm just going to return a NA value. Now, the way you could get around that is you could be more careful with describing your historical period. I was a little bit lazy, therefore I need to come up with some exception handling. Now, I want to calculate the weighted mid price. Now, this is the micro price, and all it means is that I need to get the ask size and the bid size along with this data. Very easy to do. It comes back from your response to the ThetaData API. So I can apply this, this function here to my pandas array. And essentially, all that I need to do is just apply that function there. So making that actual request to the API, essentially you're just going to send it off and you're going to return back those values, no problem. So now we've pickled that data. The first thing we want to do is we want to calculate realized volatility. Now we want to do this over a 30-day window, but a 30-day window, comparing it to implied volatility, is actually 21 trading days-ish in actual trading days. And the reason is because a 30-day period from now to the future is only going to have so many trading days, business days, between now and then. So I've computed that, I've approximated that as 21 trading days. So what we're going to do is we're going to calculate the realized volatility, so the cumulative realized volatility over that window of time. So the way that we can calculate realized volatility is I've now got the subscript H, which is this rolling window period, and that's approximately the square root of the sum of this return squared. And this return squared is the log price difference between the start of a period and the end of a period, given that the period length changes depending on how we split the 30 days or the 21 trading days up. So if I have m particular intervals, then this is my interval size, and I step through and I calculate the squared returns, and the sum of the squared returns, I take the square root of that to get my realized volatility. Now, essentially what that means, I can essentially approximate this by using the standard deviation over a rolling trading window. So let's see how I can actually implement that in code. So how do we actually implement this volatility over that trading window in Python? Well, essentially, let's make the data frame using the underlying data. We're going to create a data frame of that information. We're going to then label the index as the trade date. We're then going to calculate the log returns by taking the log of one price divided by the shift of the other column, and then we're going to apply the trading days of 21 to get our 30 days historical volatility. So let's create a new column called spot vol. We're going to take the log returns and we're going to take the dot rolling function with the window equal to the number of trading days. We're then going to do dot st, which stands for standard deviation. And then we're going to take the square root of 250, which is essentially using the same formula that we saw before. We're getting the summation over we're getting the standard deviations over a period of time, which is the trading window of 21 days, and then we're then multiplying by the frequency of every year, and this gives us our rolling annualized 30-day realized volatility. So what does that look like? Well, essentially here is what we've got. We've got price for a particular day, and then we've got volatility for a particular day, the 30-day rolling average. So what does that look like? Well, essentially we can graph it and we get something that looks like this. I've got price of Microsoft in blue running from 2012 midway through all the way through to today, and then I have volatility in percentage on the right hand side, and you can see the volatility change over time in red. Now what I want to do now is I want to get the implied volatility, so then we can plot it on top of this. So first thing we need to know is that market makers are not forced to show quotes on all options, and this is probably one of the biggest difficulties that you'll ever have when using data and trying to do historical analysis. So the rules are listed for each exchange that the market makers must abide by, and essentially for the NASDAQ this can be found here, and I'll put a link in the description. Specifically, there's a large difference between competitive market makers and what they have to do and primary market makers on a particular option series. Now, the big difference is actually where the market maker needs to actually show two-sided quotes on non-standard options like weeklies, quarterly expiries, or adjusted options or not. Now, standard option prices we're going to be using just to be safe to make sure that there are quotes there. These expire on the Saturday following the third Friday of every month, and sometimes the expiry date as the third Friday of the month. So in the past, these seem to be recorded as the Saturday, and now they seem to be recorded as on the third Friday of every month. So therefore, we're going to take the intersection of these two dates and the expiries that we have with ThetaData, which has all of them, including the weeklies, the quarterlies, and the adjusted options, and therefore we're going to then streamline it back to just these standard options so that we can, well, hopefully ensure that we have quotes present in market making activity on these option series. So I'm going to get my trading dates. I'm going to then calculate, we'll get a pandas date range of the third Fridays of every month, and then the Saturdays following the third Fridays of every month. I'm going to combine the two, and then I'm going to check all the expirations that are returned back from ThetaData, and if they actually exist in this combined list. If they do, then return them. If not, then don't. And look, I'm then going to get the number of possible monthly options contracts, which is essentially over-calculated by 2 because I took the Sunday and the Saturday of every year. But yeah, 278 divided by 2 compared to the total available 134, which it sounds right about on. That divided by 2, maybe a little bit less. And then we include the quarterly and weekly options. So the total amount of options that ThetaData provides, 563. So there are a lot of other options, obviously. So let's look at the days to expiry. So we're going to be interested in taking a look at 1 month out, 2 month out, 3 month out, and 4 month out. So 30 day, 60 day, 90 day, and 120 days. How are we going to do that? Well, essentially we're going to run through for every trading day what is the closest expiry, monthly expiry option that is closest to 30 days away, 60 days away, 90 days away, and 120 days away. And the way we can do that is we can use the difference between these two date ranges. So for a particular trading day, I'm going to build up this dictionary contracts for a particular trading day. What is the difference between all the list of monthly expiries that I have and the trade date? And I'm going to get the delta of the days, the number of days and the difference. Then I'm going to run through that list and I'm going to say, okay, the delta of the different days, what is the minimum for these particular date to expiry times, 30 days, 60 days, 90 days, and 100 days. And then I'm going to return the index back for that. And essentially I'm just getting the index position of that contract in the monthly expiration list, and I'm adding it to this contract dictionary. So just for an example, what do I actually return? Well, then for every particular trading day, I return back 4 different index positions. For example, the start is going to be in this big list. I want the first 4 months of my trading data, and for a particular day in 2001 it looks like this. It's somewhere else in the array, but you're just going consecutive months you want, but you want to know where they are so you can reference it later. Now, where are you going to reference it later? Well, you're going to reference it later here in the implied volatility request. ThetaData uses quote information on a particular option chain for a specific trading day to compute the implied volatility. So for every trading day, we're looking forward to the closest month and then getting the closest strike we want to for at the money options. So we're going to retrieve the implied volatility for the 1 month, 2 month, 3 month, and 4 month, just as we've stated. So first thing we're going to do, I need to take in the root ticker. I need this function to take in the trading dates, the interval size, and then the option type. Now, the client, I'm going to create the client and I'm going to store all the implied volatilities in this data's dictionary that I will build up. Here I'm defining my, essentially columns of data, my keys that I'll use for this dictionary, the 1 month, 2 month, 3 month, and 4 month. And then I'm going to also have a reference of the total days so I can print out as I go along. Now we're going to connect to the data terminal. I'm going to iterate through every trade date and I'm going to use enumerate so I can get the index as well. So for every trade date, the first thing I want to do is get the expiry dates for the specific contracts on those particular trade dates. So I'm referencing those contracts to get the indexes of those specific expiry dates for a particular trade date. We talked about that before. And then I'm just going to apply that to our monthly expirations to get that subsection of those expiration dates. Once I've got them, for each expiry, we want to get the closest at the money IV. So now we're going to iterate through those 4 expiration dates. We're going to determine the closest at the money strike. So the way we can do that is we can iterate through all the strikes of expiry date, and then we're going to then work out what the minimum difference is between the underlying and the strike, and we're going to use that strike. So return the closest at the money strike for that particular trading day and that option. So let's try and attempt to get the historical options implied volatility on that particular strike with that particular expiration date. And the way you can do that is you require the option requirement type .implied volatility, all in caps there with a underscore, for that particular trading day interval size. And again, I'm going to take from the 1400, so 2 o'clock in the afternoon. So here I'm then referencing, I only want the implied volatility data position back, but there are other things that come back. So yeah, just be conscious, read through the docs of ThetaData so you can see, or equally just send a request and return all of it so then you can subsection the data yourself. So I'm then going to store that data in the dictionary. So I've got, for every trade date, I've got then the specific days to expiry, so either the 1 month, 2 month, 3 month, or 4 month. And then if it's unavailable, make it NAN. So I'm going to do that for every trade date. I'm going to make the request for the API for both calls and puts. And this does take a while, but the API is very quick. So I'm going to demonstrate it right now. So the problem is really that we're doing it over 10 years of option data, which is incredible that we're going historically, we're looking forward for a particular contract, we're then doing a call, what was it at this specific time on that trading day, what was the implied volatility, which just kind of mind boggles me that we're able to do that all with one API. So to demonstrate what this actually looks like, let's just run through a 5-day week of what that looks like, and let's time how quick that is with the API. So if I send the response, essentially I'm running through the days. First we need to connect to the terminal, and then once you've connected to the terminal, it's going to run through really quickly. So I'm doing the requests for all my 4 expiries on these particular dates, and I'm running through quite quickly. So now I've done the 5 days in 17.59 seconds, and I've got for each of those. I've looked at the specific contract of the closest at the money for the 1 month, 2 month, 3 month, 4 month, closest to those trading dates, and I've got the implied volatility for 1400 every single day based on the quote level information aggregated over that period of time on that specific trading day. Quite incredible. So now let's actually visualize this. So what have I done? I've got all this data, I've got historical, and I've got implied volatility. Let's plot them together. So all I'm going to do is I'm going to build up my data frame based on all that information from 2012. And you'll notice, look, I do have some missing data in some places. So let's just plot all that out and see what data I have. And the first thing that you see when you see this graph is you're probably going to notice, why is the red, the green, and the orange line a little bit patchy before 2020? And I asked myself the same reason. Oh, is there something wrong with the API or something not happening here? And then I realized, even though I had the assumption that there should be quote level data for at the money options on Microsoft on these monthly option series, that hasn't been a requirement since prior to 2020. So I encourage you to read the NASDAQ exchange rules in detail, and what you'll notice in section 5 of market maker quotations, this actual obligation and exchange rules was only adopted in December 6th, 2019 and amended a few times since. So that's why when you look at this diagram, we've got quite patchy data for the 2 month, 3 month, and 4 month out options up until 2020, where then it becomes very reliable. But back here, it's like market makers were happy to offer all those products. And then there was this period here between 2015 to 2020 where maybe it seems like it wasn't an everyday occurrence on those monthlies. And now, here it is. Now the obligations are set out as in the rules, and they need to be actively traded by the primary and the competitive market makers, 90% for the primary and 60% of the time for the competitive market makers on the options. And here we have a more liquid, transparent, and open market. So there you go. So what does that mean? Well, essentially I'm going to only take the 1 month out, the 30-day, and we'll compare that against our 30-day 2021 trading days spot volatility. So let's plot that, and we can see now we have this graph with our stock price in blue and our implied volatility in green, and then the realized volatility in red. Now you can see here that there appears to be a very strong correlation between the two, and obviously that shouldn't come as a surprise to viewers on this channel, but if you don't know, it's okay. We're going to go through it all in this implied volatility series. So I encourage you, looking at this graph, has what we plotted, is this a fair comparison? Is it a fair representation, just plotting it day for day? So the implied volatility that I see on this trading day versus the rolling 30-day realized volatility. Well, essentially, if you believe that there's some kind of autocorrelation or power in the historical volatility or the implied volatility to kind of forecast or have some information on the realized volatility, or you believe that historical volatility is somehow correlated to historical volatility in the future, so autocorrelation, if you believe this is the case, then really maybe we should consider fair timescales. So remember, the realized volatility is backwards looking. So it's over the time periods, T minus H goes to T. Whereas the implied volatility is forwards looking over H time periods. So really at time T right now, that's actually looking at the period T plus H. Remember, H is our 30 days or 21 trading days. So to compare this visually, we could shift the realized volatility backwards by this H period of time. So we're going to shift it by 21 days backwards. So let's shift our spot vol by 21 days, and you can see now that we have the volatility listed at the beginning of the period, and then we don't have it listed at the end of the period because we don't know what they are yet. So if I then plot that out, you can see that there seems to be a very strong correlation with the realized volatility and the implied volatility. Now, we're going to do further analysis on this in the future, but now you should just see the correlation between these two volatilities. I mean, it's pretty implicit with even just the eye and observation. But we're going to get into the numbers and how you can actually analyze this and what you do with that information and how you can build up models to forecast the volatility into the future to hopefully give you some kind of idea on the process of whether implied volatility might be overpriced or underpriced in the marketplace. So we're going to go into all of that in more detail. Now, one question that I want to ask is this data different for the puts, and should it be? I pose you the question, if it should be different for a particular strike at the money, should you have a different implied volatility? Well, I built up the implied volatility. Again, we see on the puts that we have consistent data for the monthlies after 1 month, from 2020, when the rules obviously got tighter on the exchange. Thank you very much. And we've got patchy data beforehand. So if I then plot the 1 month puts versus the 1 month calls, we see very, very, very strong correlation from a particular point. So maybe for the last 5 years, these look nearly identical. Whereas before, they were a little bit more patchy. And you can almost see that the calls had consistently lower implied volatility, and then the implied volatility of the puts almost had higher for a long period of time. Now, my question for you, and we're going to answer it in another video, is why is this? Why could this be? And if there should be a difference between implied volatility at the same strike between calls and puts? So I pose that question to you. Would love to hear your answer in the comment section below.